Hey there, Wealth Press subscribers, viewers, traders, and investors. It's time for another weekly market wrap-up, and I'm joined, as per usual, by Mr. Roger Scott. Roger, welcome.
Thanks for having me, James. I hope you're doing well today.
I am. Thank you very much. So, Roger, let's talk about the year that was, since we're going into the final weeks of 2020. We'll skip over the obvious negative aspects about it, and let's talk about what was good about 2020. How did you make out during 2020? How did your subscribers make out during 2020?
Well, it's interesting because there's a lot of people talking COVID. It's a bad time for people, I'm going to say it was an amazing time for the stock market. We had volatility. My strategies, my systems thrive in volatility. So it's been an amazing year. I think, don't quote me on this number, but I think our total return on all of our strategies, and this is including losers and winners and not cherry picking anything, not on the options, on the stock, was like 1,700% or 1,500% return. We made out like bandits, James. We really made out like bandits. So it was a very, very good year. And look, for all those negative seekers out there, folks, the NASDAQ is up over 48% at new highs. How could it be a bad year for anybody, even buy and hold investors? It's been an amazing year. Look at the market.
So I think NASDAQ had its highest performing year in its entire history this year, if I'm not mistaken. And I'm not saying it touched its all-time high, but it gained the most in terms of absolute returns in its entire history, even more so than the go-go years of the dot-com. So is this going to persist in 2021?
One of the biggest benefits of having a bull market in a COVID environment was it was easier to find really good trends compared to bad trends. In other words, if you have a bull market, a regular bull market, and it's kind of like a wave. If you have a wave, it moves everything with it. So it's kind of hard to tell what's really moving on its own or what's kind of just going with the flow in a typical bull market. In this bull market, it was very, very easy because it was kind of like if it's moving the right way and if it's taking out the highs and if it's resilient to going down in that crash, it's probably going to really move. And then you look into it, and then if there's a good fundamental reason behind it, and it backs into the COVID story. Versus stocks that were just, no, this is a no-go. So in my opinion, even if you were not an expert trader, I think 2020, and maybe I'm saying the same thing you're saying just in a different way. You said it, and I know you said it in a joking way, but I just want to expand on that it actually made it easier for most traders to pick winning stocks because it was kind of like yes or no versus, well, these 10 stocks are moving and they're all doing kind of well. Well, which one is moving because it's got some behind it and which ones are just sympathy plays? So I think that was one of the biggest reasons why 2020 was a good year. It was easier to find the right stocks. I think that made it for most people a much more effective year and a more stable year to trade, because it was kind of like cruise ships. Come on, who are you kidding, right? Airlines, come on, who are you kidding? And versus like Zoom or Peloton, where it's a no-brainer. So I think that zeros and one binary effect versus having a lot of gray area had a major impact, and that's what made it easier to trade. Now, to answer your question, going into 2021. I think 2021 is going to be a vastly different year than 2020. I think 2021, we're going to see a wider, more of that gray area developing again. Why? Because you're going to have less panic. Because even if we do have an environment, and I believe we may have an environment over the next 90 days like we had in March, April, and May of this year, I think the fear, the panic, the way people deal with it will be different, because it won't be new anymore. It'll be like, oh yeah, we're seeing it, it's kind of like the boy who cried wolf. I don't think you're going to have the same lines for toilet paper and for medical supplies. I think there's going to be the response from people will be a little more kind of like, hey, we went through this before, we're going to go through this again. Let's not jump out of windows and pretend this is 9/11, God forbid. So I think the reaction is going to be different. And that is going to cause an impact in the stock market. It's going to have a broader impact. Whereas if I go back 6 months, stay-at-home stocks, biotech stocks, everything else sell, forget about it. I think it's going to be more kind of like, well, maybe, for example, stores like Target and Walmart, they have adapted to people buying online. So whereas last first quarter of 2020, people were, and the stores were not adapt. Now they are. So you're going to have, I think you're going to have, again, that stay-at-home environment, but it's going to have a lot of the other stuff sprinkled into it. And I also don't think the leading stocks will be the FANG stocks, which are going to severely cripple the NASDAQ, because the biggest stocks that drive the NASDAQ are the FANG stocks. So I think you are going to have a great year. It's going to be a different year. We're not going to see a repeat of what we had in 2020, but we're going to have some flavors of it.
Yeah, I couldn't agree more. I mean, the one of the things I've noticed happening is that in the stocks from companies involved in the search for treatments, cures, vaccines, etc., in the COVID space, and one of the side effects of the COVID pandemic is that has really accelerated the development and the advancement of biological sciences as it pertains to epidemiology and virology and all of these things. And I think that, the healthcare sector is poised to add a significant value lift to the entire stock market asset base. By way of example, I'm just watching this little stock called Cytodyne that I've been following since we did our Race for the Cure feature back in March. And this is a company that has developed, they've just finished enrolling their phase 3 trial for a drug called leronlimab that has been being used on an emergency basis for patients suffering from severe to life-threatening palliative COVID-19 symptoms, the cytokine storms, et cetera. And they're finding that it's got high efficacy and high efficacy, low toxicity, and wide efficacy across a population base. So this is a stock that's been sort of burbling along. Now they've got to their phase 3. They finished the enrollment last Friday, and 28 days from now, because all of their enrollees are people who are in the most chronic, severe stages of COVID-19, and in 28 days, we'll know whether this works for sure. The insiders are buying the crap out of the stock because they know it works, because they've issued it over 60 times on emergency basis through the FDA, and in most cases, people disintubate themselves within 24 hours. So it's just remarkable. That's an example of the kind of wealth that's being created as a result of the COVID-19 pandemic. So I think, in view of the fact that it's going to be 6 months to a year before everybody gets a vaccine, we still have to deal with the illness itself. And so in those select circumstances, I think 2021 could be as profitable as 2020 for investors in select sectors.
And
now, outside,
I just wanted to add. I just wanted to add to the value of what you were just saying. I couldn't agree with you more. But there's just one other factor that we have going in that same direction. And I'm still staying with your point. The political environment, and I know you and I are not very, this is not but I think the political environment, I think the aid that's coming because of COVID into America, coupled with the political climate of the Biden administration, Democrats tend to be more healthcare oriented. It's just the way it is. And again, I don't want to get political here. It's just the way it's been historically. So he's even promised to put a lot of the aid that's coming into biotech and research. So I think we also have that climate moving in as well.
Right. Well, that's a great thing. So outside of the biotech sector, where else do you think 2021 promises to shine?
Well, Good question. And here's what I think. I just as you said that that COVID was very good for certain sectors, there's another sector that it's been really good for, and that's the software as a service industry. There are companies in the software as a service segment of the economy that started getting headway because of COVID, and then there's companies that are adapting to it. But the point, the paramount point is that this COVID has took a technology and caused it, just like the stay-at-home technology, people working from home has been sped up tremendously, maybe a 5-year push, 10-year push because of this COVID. The same thing's been going on with the software as a service sector. Because a lot of companies like Autodesk is a mature company. It's not a new company. It's been around for probably, I'm guessing, over 20 years. I know it's been over 20 years because I know people who used AutoCAD more than 20 years ago. And they're now switching to a subscription service, and they're doing everything through the cloud. And other companies, new and old, are switching to the cloud. So companies that are able to switch through are seeing a massive increase in capital. More importantly, predictability, because these are all subscriptions, and people go on a subscription service. Subscriptions are very sticky, especially when it's a business subscription and you need it. You don't want it, you need it. It's one thing subscribing to Sirius Radio, and it's another subscribing to a software that you need to do engine designing, home designs. Also, the economy with home builders moving up right now, a lot of these software as a service companies are going to see an uptick as a result of that as well, because a lot of them are in the building infrastructure and the design building. So, and based on what I'm hearing from analysts, that industry is slated to grow over the next 5 years at a clip of about 35 to 40% year over year. So COVID, no COVID. One thing, James, about two things: medicine and technology. They only move right. They don't move backwards. There's no rewind machine on technology and medicine. It's not like a classic car that we want to go. You don't hear people talking about technology or using things from 1960 or medicine from 1960s. We're only moving forward. So
Right.
once you don't, the genie never goes back into the bottle with technology and with medicine. People are not going to give up their iPhones to go back to a flip phone or
Right.
or to 3G instead of 5G. It just doesn't work that way. People aren't built that way. So I think this COVID climate is setting up a few industries, like you said, the healthcare industry, biotech industry, and a specific segment of the technology segment. So I don't want to throw the baby out with the bathwater. My caution is in the large cap FANG stocks. And again, the political climate is not very good for that. Democratic presidents tend to break up large companies and give support to small companies. And as you know, the FANG stocks, the Facebook, the Amazon, the NVIDIAs, those stocks have not been able to take out their highs since September 2nd, James. And these are stocks that have been going higher and leading the market over the past 3 years, including the first half of 2020. So again, I want the readers and the viewers at home to be very to understand that just because I'm not bullish on large cap tech, NASDAQ 100, doesn't mean I'm bearish on tech. I think there's going to be some subsegments of technology that are going to do very, very well. And one of them is going to be software as a service segment. I think that's going to give us a lot of value over the next over this year.
Yeah, you bet.
Can I give you two good names of
Please
companies?
do.
StoneCo, and I mentioned this stock about on this broadcast probably about 6-7 months ago. The company has done substantially well since I've talked about it. Ticker symbol is STNE. It's
Okay.
obviously a software as a service company. It provides financial technology in South America. The emerging market segment right now is on par to be the strongest index with the Russell 2000, which is the small caps sector. If you want to look at specifically, there's two: ticker symbol VWO and EEM. Those are both emerging market ETFs. They have been doing very, very well. So I think a lot of money is going to move into South America, Asian, South Pacific markets we have not talked about in 2020, James, where there's a lot of value. So
You
So
mentioned EEM and VWO in one of our Friday afternoon sessions over a month ago. So that's, your consistency is remarkable.
yeah, I don't deviate a lot. I'm very consistent. It's like a story developing for me. I don't change my analysis very often. And so this stone company, they do financial technology, e-commerce, as we know. We just talked about how COVID pushed it forward. Companies like Melly have gone up $800-900 in the last year. So I'm looking for the Stone STNE to move up. 1 year return has been close to 100%. And estimates for next few quarters are positive. It's trading near all-time highs. They work with e-commerce, stores, online, mobile channels. And my current target is about $90 per share on it. And I think we're going to hit it.
Which one is that? Sorry.
Say that again.
Which stock is going towards $90?
STNE.
Oh, that's StoneCo. Okay, right.
Yes. And the company's revenue retention is about 100%. It's very sticky. It's a very sticky company. Once people use it, they don't go back. So it has very strong retention. And the numbers are very, very solid. And I think this company is going to do very, very well. It posted in the third quarter of 2020 its highest historic figures on total payment volume in revenue, adjusted net, and even more. The next stock, yeah. So I like this. This is a good example of a software as a service company that I'm talking about. And I'll give you one more if you don't mind. It'll just take a minute. It's called Palantir Technologies.
Palantir.
Yes.
Yeah, I know it. Know it well because we've been following it. It's Peter Thiel's baby, right?
Yes. So this company. One thing I track is companies that sign contracts with U.S. governments. They tend to do well. I mean, look, Microsoft. Let's not fool ourselves. Microsoft went from being an ordinary tech company to being the tech company after they signed their contract to provide the government with their products in the early 90s. It's just how it is. I mean, you can Microsoft Word, Excel, when it all switched. You and I are old enough to remember Word Perfect, the switch to Word, government, all. Well, they signed a government contract in the early 90s, and that's what really took them from being a big company to being the biggest company. So again, Palantir's global defense lead, the Army's proactive approach is seeking out opportunities to deploy commercially available solutions, has been instrumental in the hands of war fighters faster. This company just signed a contract. Typically, as I said, and governments tend to not default on their contracts. So the company is doing very, very well. I think this is a big catalyst for the company, this government contract that they just signed, and the company is set to do very well. And third one, and the last one is Elastic, ESTC. They do data software driven. 1 year return, 124% on this company. Year over year revenue growth, 43%. They've got tons of cash, and they've got 650 contracts that are worth over 100,000 each. And I see an upside in the stock for about $200 per share. So these are my 3 software as a service companies that I believe will do very well over the next 12 months.
That sounds great, Roger. Okay, that's awesome. Well, let's leave it there for now, Roger. We'll come back to you shortly in the new year, and we'll continue the conversation. Have a very exceptional holiday season, and I look forward to seeing you again soon.
Thank you, James. Have a happy holiday and a happy new year, and thank you for everybody watching and listening to us here. Bye, everyone.